All right, so today I wanted to make a video on the YieldMax ETFs. These are very, very popular. They're the most popular of the really high dividend yield ETFs. Roundhill is probably close, but I think YieldMax is probably number one there. But I wanted to make a video because a lot of these funds have been underperforming recently. A lot of them did really good to start, but a lot of them are, in fact, almost all of them are underperforming right now. And I sold all of them except for one, MSTY included in that group. The one that I still own is CHPY, which is actually doing pretty good, but I'm still watching it closely. So I wanted to go into detail why I think that these funds are, I don't know if misleading is the right word, but why I think that they're not worth owning. First things first, if you get value out of the video, please like and subscribe. Check out the links below as usual. So let's start. I'm going to do it. I'm just going to look at the top. I guess it'll be 6 ones by market cap because honestly, they're all pretty much the same story. So just to kind of make a point. Now, the biggest one is MSTY. And if we look at MSTY here, MSTY is actually up ever since it came out. Actually quite nicely it's up. But its share price is down 45%. And on top of that, if we go year to date, right, if we go year to date here, or roughly year to date, it's down 12% with reinvesting dividends, and the price returns is about minus 56%, right? So this is going to be a normal, a kind of a sign of things to come, is that yes, these funds pay these crazy high dividends, but you get this uncanny negative share price returns. Let's check the next one here is ULTY. So this is one I believe I did make a video on it recently, but nonetheless. So this is one that actually ever since it came out, the price returns is negative 72%. Underperforming the S&P even with drip. But let's go year to date. I think it's actually basically on par. Yeah, it's actually ever so slightly outperformed the S&P. But again, we have negative almost 42% price returns. And this is something that is going to kill these funds, right? It's going to kill these funds. My prediction is, 5-10 years from now, most of these will not exist because the share prices are just going to keep going down and down and down and down and down and down. Now, again, they may not go down to zero, probably not. But I still think that the share price erosion is just going to be too much to ignore. The next one is NVIDIA, or NVDY, I guess. So if we look at this one is, again, it's outperforming a lot since inception. It's actually not down a ton. But you also have to keep in mind that NVIDIA is one of the best performing stocks in the entire market ever since this came out. So if we go year to date here, and again, a lot of these, the underlying is actually up on the year. So that MSTY I think is actually down slightly, but a lot of these, the underlying is actually up. So again, this one has slightly outperformed, but again, you have negative almost 35% share price. The one thing that I would throw out as a caveat is that once the price gets so low that if they can maintain the dividend, it might be too hard to ignore. The problem is nobody really knows where that is, right? Nobody really knows where that is. And not to mention, too, a stock or an ETF, in theory, can go down 50% per year from now until the end of time. I mean, eventually it'll get to it's 0.0001, but you get the point, right? It can go down 50% a year, right? Because it's just getting cut in half. So I think that, long story short here, I think that the negative share price appreciation is going to kill these funds. The next one is going to be the Coinbase one, CONY. This one, again, also is up since inception, but again, you have negative 67% price returns. If we go year to date on this one, yeah, you're also getting killed. You're negative about 8%. It's down 54%. So this one's getting killed. The next one is going to be the Tesla one, which I believe is going to be a similar story here, up since inception, down on the year. Actually, it's not even outperforming since inception. So that's pretty telling. And then you go year to date here. Yeah, it's positive with drip, but it's still getting killed by the S&P. It's down 41% price returns. And then the last one here we'll talk about is YieldMax. That's the next biggest one here. I think this is kind of their fund to funds. So again, this one actually is relatively flat with the S&P. Actually, it's up slightly, but again, you have negative 37% price returns. And then again, actually year to date, you're also about flat, but again, you also have negative 26% price returns. So this is the big problem with these funds, is that paying this high of a dividend is just not sustainable, right? I mean, if you look at like, let's take MSTR, for example. If you were to simply sell, let's say, 10 to 15% above current share price calls weekly on MSTR, you'd be looking at about a 50% dividend yield, give or take, depending on the volatility. But again, when you got MSTY that's getting 100%, well, where is the rest of that coming from? And it's coming from two things, really. It's coming from paying back your own money and taking on excess risk. Now, again, excess risk works good when times are good, but the problem is that even when times are okay, you're still going to underperform. So you need times to be really good for these funds to clearly outperform. So I've sold, like I said, the only one of these, at least of the YieldMax funds that I still own, is CHPY. This one came out like right when the market bottomed this year. I made a specific video on it, but April 3rd, almost exactly to the day. If you look at the share price returns, it's up 26%. It's up 55% with drip. So it's absolutely destroyed the S&P. Even on just share price returns, it's beat the S&P. So this one has done really good. The one thing that I would say about this one is it is kind of a fund to funds in that it doesn't have a single underlying. Like, I mean, it's actually pretty well diversified amongst semiconductor names. So I think that that's helping this one out. But again, it also came out at the perfect time, like the absolute perfect time. And another thing you have to keep in mind with a lot of these funds is that a lot of them did really good for that first, 6 months to a year, even year and a half. And it's kind of tough to say. Like, this is one that I'm going to be watching really close. I'm watching it really close, because if it ever clearly underperforms the S&P over like a 1 year plus period, that's my cue to dump it. So a lot of people probably are wondering, okay, well, what are some better options? I think that WPay has actually done a decent job. Again, this is another one that has not been around for very long at all. It just came out about 7 weeks ago. It has outperformed the S&P ever since it came out. It does have positive price returns, so it has that going forward. It does pay a good dividend. This is another one that is a fund to funds one. It's the equal weight Roundhill fund. I think that this one also has a flaw in that, from the looks of things, it holds all of their funds. The problem with that is I think it should be dumping the underperformers. I would say get rid of the bottom, 20 to 25% of funds based on total drip returns over the last, let's say, 6 months. I would just include the top, 75, 80%, based on drip returns. That's what I would do. But again, I'm not the one running the fund. It is an equal weight fund. However, I don't know when it rebalances. Clearly, the AMD fund has outperformed recently, but the MSTR fund has underperformed. So this is one that, again, given it is a equal weight index, that it definitely has that going for it. I think that might be part of a solution to some of these funds, and that the single stock ones just don't seem to do very good. Especially over a long period of time, over short periods of time, they can do really good. But of the ones that have been around for over a year, I don't know if there's a single one of them that's like clearly outperforming, at least over the last year. So that's basically what I'd say. Blocks has done pretty good. This is the Nicholas crypto ETF. The one thing that I did notice about this one, after I dug a little deeper on it, it does have like iron, for example, in it. This is one that used to be a Bitcoin miner. They've got into a lot of the AI stuff recently, and I think that they've gotten a lot of hype, and a lot of the returns that they've gotten are not sustainable. So again, it is only 5% of the fund, so I don't think it's necessarily going to kill it, but this is an example of a stock that I think you would see it go down, 90% over the next 5 years, and it wouldn't be surprising at all. I'm not saying I'm shorting it or I would short it, because it certainly could go higher. But I think that that's just an example. But as far as the weekly payer ones, these are actually the only 3 that I have right now. I think that the solution to these funds is sell weekly calls or daily if they're available, but just be more conservative and don't do any NAV erosion, as in don't pay back any of your own money, right? That would be the very simple thing to do. The problem with that is that the dividend yields wouldn't be nearly as high, but again, you wouldn't get killed in the share price, right? You wouldn't get killed in the share price. I would almost be a fan of, only sell calls on like half the shares or 3/4, something along those lines. Because that's really what's killing a lot of these funds, is that they're way, way too aggressive. And not only that, they're paying you back some of your own money. So then again, there are tax benefits to that technically. That is a benefit to it, but it's still not what it should be, right? It's still not what it should be. I think in Canada, we have some really good options. The one thing I do know is that BlackRock is coming out with a Bitcoin covered call fund that I think, I have no idea what it's going to look like, but I think it could be really interesting. But I mean, here we have HDIV is a really good option. Again, this one only pays like a 10-11% dividend yield, but it's actually outperformed the S&P since inception with DRIP actually by quite a bit. And it's been around since like 2021. So it's been around for quite a while, and it's outperformed the S&P. You have, positive 20% price returns during that time. So it's returning like 4% a year just in share price returns, let alone that 10-11% dividend yield. Another good one that's came out recently are the other Hamilton ones, the Q-Day, C-Day, and S-Day. I'll just use Q-Day as an example here. These ones actually pay bi-weekly, or bi-monthly, sorry. But again, these dividend yields are around 20%, which is really good. And I think that that's the problem with a lot of these funds is I think that they should be more conservative, aim for like a 20-25% dividend yield, maybe 30 if it's a really volatile stock. But we can't have the negative share price returns, because that's just killing people. I mean, it killed me in a lot of ways. Now, again, the dividends did make up for a lot of that, but still lost a little bit of money. But again, it's not the end of the world. It can be easily made up over the long run. The other one I think that's kind of interesting that's came out recently are some of the 9 points ones. ECHI is kind of their the fund to fund one. These ones are paying about a 15 to 20% dividend yield. It does pay monthly, but again, you also have positive share price returns since coming out, which is really nice. So I think that is probably the better way of going about dividend investing, in my opinion. Is don't be so aggressive on the yield. You don't necessarily need a lot of positive share price appreciation, but at the very least, you can't be losing money, especially in the double digits per year. Like, that's just not sustainable. That's not sustainable at all. So that's what I wanted to talk about as far as the YieldMax funds go. I'm kind of torn on them. I think that there's still a lot of people that will own them just because they pay the high dividend. But again, they're not a good long-term thing. Like I said, I think a lot of these funds, not all of them, but I think a lot of them are going to not completely disappear, but at least partially disappear over the next 5 to 10 years, just because there's no way they can keep going down 10, 20, 30, 40% a year and still make it go with things. It's just not going to be sustainable. So anyway, that's what I wanted to bring up today. If you liked the video, please like and subscribe. Check out those links below and stay tuned for more.